Hello and welcome to our first investment strategy update of 2025. The US economy and politics remain in the global driving seat. High-octane US growth still dominates the world's financial markets, which are now likely to be further boosted by the new administration's policies. As Donald Trump takes office, US growth remains consumption-driven, with spending fueled by wage growth. The labor market is healthy and wage growth consistent with inflation close to the Federal Reserve's target. We do not see yet any signs that this cycle is coming to an end. But a key question for investors in 25 is, will new tariffs and immigration policies trigger a new wave of inflation? And crucially, where does this leave the Federal Reserve? Well, we believe this inflation will continue until tariffs start to bite towards year-end. Strong US growth means that the Fed will need to keep interest rates higher than other major central banks. We anticipate a much slower pace of easing this year, with only 2 cuts and a terminal rate of around 4%. For other major economies, the situation is quite different, and the growth outlook lower. The European Central Bank and the Bank of England will need to cut interest rates much more, creating divergences around mid-year as the Federal Reserve keeps rates higher. For Europe, central bank support is absolutely essential, given threats to growth, although we see limited recession risks. The outlook for the euro area depends on how it tackles economic and political vulnerabilities, including Germany's weakness and its trade relationship with the US. In China, stimulus efforts look aimed at offsetting any new US tariffs, but more support is necessary to keep stabilizing the property market and to resurrect consumer confidence. The economy would also benefit from extra liquidity, and China's authorities may tolerate some currency depreciation if its exports deteriorate. Growth in Japan remains positive, with a tight labor market and solid wage growth. Inflation is likely to stay above target, suggesting further interest rate hikes by the Bank of Japan. Globally, we see growth expanding thanks to the strong US economy. With interest rates high in the US, we need to watch how sectors such as manufacturing and trade perform. Geopolitics and potential tensions in US public debt are other major risks we monitor. So what does this all mean for portfolios? Well, the year started with market jitters as US yields rose to reflect concerns about overheating, interest rates, and America's debt. But the US economy's fundamentals are strong, and rate cuts, coupled with solid corporate earnings, are a constructive environment for US equities. Rising bond yields do not mean the end of this equity bull market. The US is not on the verge of recession, the Fed is not about to hike interest rates, and inflation is relatively close to target. This is why we keep our global portfolio risk exposure above strategic levels. As long as US bond yields rise because economic growth is resilient, stock markets can keep performing. In fact, corporate earnings are still solid and should continue to be powered by technological development, global growth, and lower interest rates. We remain overweight equities with a preference for US and Japanese stocks. Reflecting our less positive expectations for the Eurozone economy, Europe stocks are our least favored market. We keep our fixed income allocations at strategic levels for now, favoring investment grade and high-yield corporate bonds, especially US high-yield credit. These assets offer better income and yield opportunities in comparison to government bonds. Within sovereigns, we prefer German bonds, which should outperform US treasuries. We expect the US dollar to remain high against major currencies, thanks to US trade policies and interest rate differentials. Of course, the dollar also acts as a haven from geopolitical risks, and this is why we retain our overweight exposure. Another haven, gold, should continue to perform as well, because if demand from central banks has slowed, it remains the main factor supporting prices. Finally, alternative assets, especially hedge funds and private assets, can play a very useful role for eligible investors by extending opportunities and diversifying returns in a multi-asset portfolio. With the new Trump administration, investors will have to brace for turbulent times, but with the right portfolio drivers in place, even a wild ride can prove rewarding for investors, and we remain quite vigilant. Thank you so much for watching.